Today we're going to be talking about bull call spreads in Robinhood, also known as long call vertical spreads, and they are a great way to trade options and go long on a stock without using so much capital. If you want to buy an option that's really in the money to reduce your risk and kind of far out as far as expiration goes, it can be pretty expensive. So this is a good way to reduce the cost of entering a trade and also increase your probability of profit and maybe reduce some risk as well. A bull call spread is a bullish option strategy where you will buy a call that's typically at the money or a little bit in the money, and then you will sell or write a call that's going to be a little bit out of the money. And you can see here with a bull call spread, you actually limit the maximum you can make. And by doing so, you reduce your risk and increase your probability of profit. But we're going to go into that a little bit more here in a second. But let me show you a few things first. So the call you buy, which is going to be this guy right here, you can actually figure out the strike price of it looking at this profit loss here. So the strike of the call you buy is going to be the stock price where you start hitting your maximum loss at expiration. This is all at expiration. So as you see here, you start hitting your maximum loss when the stock price is trading at $30. So that is going to be the strike price of the call you bought. And the call you sold is going to have a strike price of 40 because that's where the break even is. So that's how it's always going to pan out. The call you buy, you're going to hit max loss when you're hitting the strike of the call you buy or lower. And break even is going to be at the strike of the call you sold. So here we are at optionsprofitcalculator.com, and I'll show you a few more things about bull call spreads. This is a pretty handy website to see your potential profit and losses. So we're going to hypothetically be trading AMD, as you all should. Don't hold me against that. We're going to buy one contract and sell one contract. Let's go ahead and choose one. So we're going to go to October 19th for expiration. And typically you're going to be doing it a little bit at the money or in the money, like I said. So let's go ahead and buy the 27 strike call. That's a little bit in the money. And then we're going to sell the 28 strike call. That's a little bit out of the money. We'll take a look here. Now, as you can see, as compared to a long call, you see a lot more green up top. Usually you're going to see some red leaking into the top half here when you just long a call. And this is because although you're losing some premium due to theta on the option you bought, you're gaining some on the option you wrote or sold. Since buying or writing a call is the exact opposite of buying a call, you're going to actually be receiving some premium each day that passes from the person who bought it from you. So that's going to start to negate some of the butt-kicking aspects of theta from the call you bought. So that increases your probability of profit right off the bat. And as you can see here, and we mentioned it just a second ago, $27 is the strike of the call we bought. And at expiration, all the way to the right here, you can see the dates at the top. At expiration, that is going to be our max loss of $44. And if you look up here at the 28 strike of the call we sold, if you go all the way over, you can see that our max profit is going to be $56 up there. Now, if you want to risk a little bit more, there's a really easy way to do this, and this is by expanding the distance between the strikes. So let's go ahead and move our $27 call a little bit more in the money to 26, and the one we wrote a little bit more out of the money to 29, and I'll show you what I'm talking about here. So you can see our max loss and our max gains have moved further apart because our strikes are now further apart, and our max loss is now $136. So we are entering the trade with a little bit more cash monies, which makes the risk a little bit higher, which increases the max profit you can take, which is up here at $164. So that's a good way to do it. If you are curious how much you're paying to enter the trade, let me show you here. So let's go back to the one we were initially doing. When you buy a call, you're paying $245. You're paying the price of the options contract. Now, when you're writing a call, you're actually receiving $201, and that is going to reduce the price of the trade. So if you can see here, the difference between $245 that you paid and the $201 that you earned from selling the call is going to be $44. Remember, 44 cents per 100 share of those 100 shares of the options contract. So plus sides of trading a bull call spread is that probability of profit is increased, your risk is decreased, and there's less money needed to enter the trade. There's one more thing I wanted to show you here, a useful way to use bull call spreads. If a stock price is trading upwards like this, all right, it's bullish, and you bought a call right here at the bottom, and maybe here you made 500 bucks, but you notice it's starting to take a little bit of a contraction. Instead of leaving the trade altogether, what you can do is enter a bull call spread. And by doing so, if this is a profit loss of a bull call spread, you reduce the amount you can lose. So you brought this up. This is your long call. All right, this is max loss of long call. You brought this up. You capped off the max you can make, but you haven't completely gotten rid of your upside like you would if you totally left the trade. So if it turned around quicker than you thought, you can actually still make money. Just not as much money if you're just along a call. But this way, if it goes down, you're not having to ride that premium all the way down and wait for it to recover. You're limiting the pain on the way down to limit some gains. But you know what? If you sold a call, entered a bull call spread with this call option, you can buy it back if it starts turning it around, if you have the money in your account, because you earned money. It was debited to your account, credited to your account, excuse me. So you have to buy to close that leg. But you can close it and then just be long a call again. So it's a good way to manage the ups and downs if you're into that kind of thing. Sometimes it's best to, not watch every minute and try to time the market. But, that's up to you. You guys are trading options, so you like doing risky stuff. I like it. Let's head over to the Robinhood platform, and I'll show you how to enter a bull call spread there. So I'm going to give an example on the website platform. It's basically the exact same on the phone app. But you're going to go to AMD or whatever ticker you want to lose money on, and you're going to go to trade options. We're going to move our expiration. Well, it doesn't really matter. You can choose whatever you want. And you're going to buy a call that's a little bit in the money, typically. So we're going to do this one right here. You're going to sell a call. It's a little bit out of the money, typically. So we're going to do one right there. As you can see, we paid up here in the top right, $246 for the call we bought. We were credited $163 for the call we sold, for a total cost of entering the trade of $83. So that's how you do it on Robinhood. And it's good to know that you want to be trading these in low volatility environments. Not sure if I said that already. So that you can collect premium as implied volatility increases. So it's the same as a long call in this case. So if you guys have any questions, sorry about that, let me know. Otherwise, I'll see you.